Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Hello, and welcome back to the podcast. Thank you very much for being here. I appreciate it. Today, again, we are going to give you a 2-for-1. This is going to be on farming without the bank and without the bank. So if you listened on one, save your time. You don't have to go to the other one. But this is so good that I wanted to make sure that I shared it with everybody. Today, we are going to be talking about lies, and lies, as Nelson would have said. And I have a guest, Chris Kirkpatrick. That is not easy to say, by the way.
No, it's not.
Let your parents know this. That's from Life 180. Chris is also a life insurance agent and a colleague of mine. This is so fitting today because we are going to be talking about whole life and IULs because of a document that I received from a client that got a document from an agent with a bunch of lies on it about IUL versus whole life. And Chris was the director of business development with the number one IUL company in the country. He figured out that IULs were nothing but lies, and he is a huge advocate of why IULs are not good. So there is no one better to have as a guest today than Chris. So thanks for being here, Chris.
Awesome. Well, thanks for having me. And just so you know, my name is a handful to say, and it took me 7 years to convince my wife to change her name. So she will testify to the fact that my name is hard to say. So.
Well, it's not the Kirkpatrick isn't so bad. It's the Chris Kirkpatrick.
Yeah, and try signing it. It's just, it's a bit of a pain, but it's all good.
Yeah. So, all right. I want to share my screen because I want everybody to see exactly what we are going to be talking about today. And I'm just going to share this for a short time. I'll put it up and then I'm going to take it down and we'll just talk about the bullet points as we go. So I have a client that is doing some estate planning, and the estate planner is apparently a life insurance agent who, in my opinion, should lose his license. And I don't say that lightly. I don't think I've ever said anybody should lose their life insurance license. But there's a bunch of...
I've said that a lot. I've said that a lot. I'm a bit more opinionated than most people, though. So
yeah,
it's okay.
Chris is even more outspoken than I am. But the first thing that I want to point out is that the document says, for those of you not listening on YouTube, the document says comparing life insurance solutions, becoming your own banker. Well, let me just do this one more time. The title of the book, Becoming Your Own Banker, The Infinite Banking Concept. We have, and Chris, you and I are on TikTok, and we see a lot of stuff on the TikToks.
Yep.
They have, because Infinite Banking Concept is trademarked, we have this huge movement on social media, Become Your Own Banker, which is the same dang thing. And I will refrain from cussing on my podcast because lots of people have their kids listening. So it is the same thing as the infinite banking concept. They have separated the title of the book from the concept. And so this is the part that even makes me more mad than the I'm going to try to sell a IUL. The misleading of the concept. I mean, they're actually using the title of Nelson's book.
Yeah, I mean, I wish, that because the Nelson Nash Institute, and I don't know all like the technicals behind how they have this all set up, but I heard something saying that the infinite banking concept is trademarked. I wish they had trademarked the title of the book, Becoming Your Own Banker, as well. That way, anybody that wanted to be like a bad actor and mischaracterize the philosophy and the concept, would be able to be held to task. Unfortunately, it sounds like it's the infinite banking concept is the only thing that they actually legally protected with trademark. And so this has opened the door for a lot of these horrible social media people out there and I'll say this is like, I don't think a lot of people actually, let me take a step back. I don't think they're all bad, right? Like I think there's a lot of these people that get into the business, they join an IMO like a World Financial Group or People Helping People agency or a PFA. And like I could list off, a bunch of these companies. And these companies are focused on IULs. They sell IULs. And so, I mean, just look, overview of this document is it's designed to kind of show you, here's what IUL is, here's what whole life is. But all the information is kind of geared to shift you to an IUL, right? Like that it's a sales document to really be like, we could do both, but here's why you want to do an IUL, right? Like that's the idea. And so all these agents join the industry and they don't know anything from anything, right? Like, and so the challenge is like literally there are hundreds of thousands of agents joining the industry. And I call it the blind leading the blind and I do this. And like you said, I am extremely outspoken on this because I think my job is to protect our industry, right? Like that's kind of how I look at it. And when you have a couple 100,000 agents out there misrepresenting a product entirely, it's going to hurt a lot of people. That's going to lead to regulation reform, which it already is with regulation AG 49B just updating AG 49A on May 1st, so that's, really 2 weeks ago, this another
for IULs.
For
IULs, not whole life, for those of you that are listening.
Correct. But that is another regulatory update on the IUL side of things. But here's the challenge. Every time, it's kind of like, when we've all seen the movies, right? Of like the cop or like the FBI agent with character and morals and integrity, and they're chasing the bad guy, and the bad guy's always a couple steps ahead, right? Because when you cheat and you do things that are nefarious, it's hard for the people that follow the rules to keep up with you. And so what's happening is regulators change the regulations, and then the companies, the life insurance companies themselves, immediately they go, well, if we have to follow that, then our sales are going to go through the tank. They're going to go in the tank and they're not going to do well. And so we gotta keep the game going. So how can we get around this? And so then they get creative and
people like misunderstanding it is one thing, Chris. Yeah. This dude was handed my book. Don't tell me you misunderstand when you've read my book and you've read Nelson's book. So here's my thing. There are agents that are out there selling IUL, and I 100% agree. It is the blind leading the blind. But when they get called out on it, when they know the truth and they still decide to go this route, that's ignorance at that point, because you're not teachable and you have arrived, as Nelson would say, right? Because now we're doing what? We're chasing rates of return. We're chasing money. We're not doing becoming your own banker. And so with that, you have ignorance, in my opinion, doing IUL, which is exactly leads back to the regulation changes and the company changes. And that is one piece that I don't talk about a whole lot, but it is a valid point that the companies want to sell insurance. And so when people say, well, what happened to whole life? How come nobody knows about it? Because of rates of return, because insurance companies want to sell a product and the agents then get told to sell that product. So that's all they know. They don't actually do more research than that. And I am not going to say I've been perfect from day one.
Right.
But guess what? Neither have you, because you worked for the company. But both of us saw the light. Mm-hmm. Right. And I started with IBC. I did not sell life insurance until IBC, but I did not work with the most kosher individual from the beginning.
Okay.
But I continued to look and to learn. And I didn't stop even when they said, oh, no, you don't need to know anything else anybody else tells you. I don't what? Why? Why would I just everything you say is gospel? Right. I want my clients to listen to other podcasts, and they do. They listen to all kinds of other IBC podcasts. Yeah. And that's good because there's a different view for all of us, and then we can discuss that view.
Totally.
But when you know the truth and you're still doing this BS, that's when I get mad.
So I mean, I'm kind of playing devil's advocate a little bit here because you and I are on the same page 100% with this. What I will say to that, though, on the other side of it is there are people that just believe what they believe because the hard part is the problem isn't really the agents. I mean, it is to a certain extent, but the real problem is the companies that are pushing this agenda. Because what happens is when you're an agent and you join and you don't know what you're doing, you follow an upline. So let's just say you and I was a new agent and you were, a person that had some sort of success with an IUL company and you were like a manager or an agent, that had this success and you recruited me in and I'm joining your team. I'm going to look to you for guidance, right? And I'm going to look at you and you're going to tell me what's going on and I'm going to trust you. Because if I didn't trust you, I probably wouldn't join your team. So I'm at least going to have a certain level of trust for who you are, your reputation, your background, your experience, your success, so on and so forth. And then I'm going to plug into your training and you're going to tell me some things. And then I'm going to go to the carrier and I'm going to look to the carrier, the insurance company itself, for training and for validation that Mary Jo taught me the right way and that everything she said is in alignment with the carrier. And the problem, that's where the problem exists, right? Like the carrier, it's a top-down problem because the carrier is pushing this horrible information and misrepresenting what these products are for people, misrepresenting the expectations that these insurance agents should be able to utilize and how to communicate what the illustrations are all about. So it's not that I don't agree with you. Like obviously people, read Nelson's book, they read your book. I mean, on it, like full transparency, I've never read your book in full. I've got it. I've read the beginning of it.
You probably don't need to, Chris. You're okay.
But like, so I don't know how much you put in your book about like IUL and other things.
I don't have anything in my book about IUL.
Okay, so
but I say not to use universal and variable. I don't think I have IUL in there because I don't think IUL was a real big thing. But at the same time, we can't take 100% responsibility off of the agent for not doing their due diligence. As you get into the business, you should be doing your due diligence as you meet people.
Okay.
And so it's a full approach issue.
I agree.
I'm not going to say it's just the agent, it's just the company. I think it's a full approach issue because you get to companies like One America that I write with the majority of the time. They do not sell an IUL product. Yes, they will index the dividend, which I think is complete BS. And I even got mad at them for that. I don't even like the fact that there's a variable product. Like those things I do not like. And I will question that. But I think it's a full issue. But as an agent, the agent learning it completely incorrectly, I have had to eat a lot of crow over the years to reverse the damage of what was done in the first 2 years of what I learned. But I was paying attention and I was asking questions along the way. I was not just saying, oh, well, you know what? It's not a big deal. I'll just believe everything that person says. And so I feel like it's a consumer issue for maybe not doing due diligence. I feel like it is an agent issue. It's a company issue. It's an all around whole issue, but I put way less. A lot of people want to blame the consumer. I'm like, they're not a life insurance agent. I have a really hard time putting anything on the consumer if they don't even know that whole life exists versus IUL or vice versa. We're out here doing the best we can do, but okay, let's get into this document.
Yeah, let's do it.
Go all day.
You can do this all day.
All
yeah,
right. So becoming your own banker, this is what they are saying. An IUL, you can take a withdrawal and put back at any time. In a whole life, you can take a withdrawal of paid up additions, but can't pay back. So Chris, I'm going to let you take the IUL side of this if you have anything to add on the withdrawal.
Yeah. So first of all, when you withdraw money from a policy, you cannot put it back.
Can you in an IUL?
No, you cannot.
But this says you can.
Yeah, that's a flat out lie.
Lies. Lies.
So,
I think we found one lie.
Yes, that's definitely a lie. If you can always in both policies, and I'll let you get into the whole life, but you can borrow against an IUL the same way you can a whole life. However, the challenge with an IUL typically is that the surrender charges are much higher, right? And so what happens with an IUL is that you have Everybody likes to say IULs are more transparent because they show more columns and they show a breakdown of the expenses and the fees and all that stuff. But I'll tell you this is like they tell you that's more transparent, but the only reason they give you that whole fees and expense report is because of the top corner or the bottom corner or wherever the asterisk is based on the company that says we're showing you these fees, but these fees are assuming current rates, and the company has the ability to change these and increase these fees at any point in time, right?
Yeah.
And effectively, I mean, everybody's got their own little legalese, jargon, whatever, but that's the purpose, is that asterisk, right? And so when you look at that, now it's like, all right, I know that this policy is only going to perform according to those, fees that, I'm not in control of it. And so when I look at any asset, I'm looking at control as the number one attribute I'm looking for. When I sign on the dotted line with an IUL, I don't have the control. And with the IUL withdrawal component, if you withdraw from a life insurance policy, there's no putting the money back. You can borrow against it, but with an IUL, you can only borrow against the surrender value. And so
so we cannot withdraw and put money back in an IUL. And the same with whole life. You cannot withdraw money and put it back. And the reason why is because when you withdraw, your death benefit decreases. So if you were to put it back, that means they're going to give you more death benefit. Now you're asking the insurance company to raise your death benefit, but we don't know what happened to your health in the meantime. So you could have become uninsurable, terminally ill, and now what we want to do is put a bunch of money back into the policy, buy more death benefit, and put the company at risk. This is not universal health care. This is life insurance, privately owned companies. They're not going to take that risk. And you, as the policyholder, should not want them to take that risk. But I was not certain if you could actually take money, would do a withdrawal and put it back in an IUL. Okay,
no,
so that's number one.
That's just a cash value insurance thing across the board, right? Like,
okay.
And I'll go there further. Is like, why would you ever want to withdraw from any policy? Like, if you do that, the tax. I mean, we could do a 20-minute video just on why doing a withdrawal is just dumb.
Now, even a withdrawal. So, and that's on here later. Yeah. So I'll get into that later. Okay, number 2. An IUL, you can take a loan.
Yes.
A whole life, he says you can take a loan against cash value and will be charged interest, which will affect future performance. So apparently in an IUL, it's just as easy as to take a loan. So, Chris, is there interest charged in an IUL loan?
So yeah, of course, yes. So here's the deal with IUL. IUL has 2 different loan options, whereas with whole, I'll let you explain the whole life after. So with IUL, there are 2 different loan options. There's effectively what's called a standard loan or a wash loan, meaning if you take a loan rate at let's say 4%, they're going to give you a 4% crediting rate. And so a lot of IUL agents will sell this feature as a huge benefit, right? Because you could either do a wash loan and have that 4%, and your money in the policy is growing at 4%, but you're paying a 4% loan rate. So that sounds really good. Or you have what's called an index loan or a variable loan. And that loan, the whole idea there is that it's kind of like the non-direct recognition idea, right? Is like, okay, you're going to get your crediting rate, whatever it is, and your loan rate will be, let's say 5%. So it's a higher rate typically than the wash loan rate. But you have the ability to participate in the index still, right? So if the index got you 6.5% and you pay a 5.5 or a 5% loan rate, the idea here is that you have this 1.5% spread or arbitrage, positive arbitrage. And this is the challenge. This is where the regulatory issues are really existing right now, is that the illustrations allow, and not only allow, they automatically do this, 50 basis points of positive arbitrage when you take out loans every single year, and they never show a down year. And the problem with this is now when you borrow with a whole life policy, you have more control and more predictability. And I'm going to let you get into all the benefits of that. But with an IUL, the challenge is, especially when you look to take IUL, because most people are getting an IUL because they want like tax-free retirement. They want all this stuff. They talk about the becoming your own banker, and they try to like position it out there like it's like, they try to position it like it's whole life on steroids, right? It's all the benefits of whole life, but you got more upside. I got news for it. If you believe that, like I got a bridge in Brooklyn I can sell you. I always kind of tell people, not to get like off track, but life insurance companies do one thing and one thing well. They manage the purchasing power of your money, and they're going to protect your money, keep it safe, help it grow, but you're not going to get rich. Like life insurance companies are not great at taking risk. And so you and I know, like, let's use common sense. And I think it's really relevant for this conversation about loans, right? Because you and I know, Mary Jo, like life insurance companies' general accounts right now are getting anywhere between 4 and 4.5%. Now that number is going to go up, right? And as it does, dividend rates will climb with it, right? Which is great. Life insurance, like whole life policy holders will benefit from that, right? On the IUL side, it's not the case, right? But think about it this way. IUL, I always tell people, if you use a little bit of common sense, IULs make no sense, right? Because if, in fact, the agent is showing you an illustration and then saying you can borrow against this and you're going to earn this positive arbitrage and it's going to happen every year, and the life insurance company is going to conservatively get you 6.5% over the next 40 years, the life insurance company can't even do that for themselves. They can't even do that for themselves without having all the costs of insurance and everything tacked to it. How are they going to do it for you? It's not possible. It's mathematically impossible for them to do that. And so you got to think about that. And so then the other thing about this is, like, on the illustration, it shows positive arbitrage every single year for 50 years in a row, or whatever the number is on your illustration, however long you have it going out into the future. And so the problem is, if we do the historical look back method, and every IUL illustration will show this. So when you look at the loans and you're like, all right, I'm going to get this, it's going to look really good. And the agent pitches it as really conservative. And then you look at the 20-year look back period, because that's the regulation, that's what they make you do. You see that 35% of the time, the market performs worse than your interest rate that you're paying. So 35% of the time, that means you're going to incur more expenses than you're showing. Right? Like, and so that means the policy is going to perform worse. So yes, you can take a loan.
So can I stop you and break this down? I don't mean to interrupt you, but you're like me. You'll just go forever. So if I take a loan at 5%, but the market is at a -10.
Yep.
I went down to 0, because that's the one thing IUL say is you're never going to go below 0, right?
Yeah.
So I mean, we've got expenses, but so it's 0. So now I paid it is actual 5%, because the market went below 0. So I got 0, right?
Yeah. I mean, yes. I could get,
so at a 5% loss,
it
costs me 5%. If we just want to like make it super easy compared to what you're saying on loans, we can do the wash loan, or we can have an arbitrage. But if the arbitrage doesn't work and we had a market like we did last year when everything tanked, it actually cost us 5%.
I'll make it even worse for you. So once you get into retirement and you start utilizing this, because it's the predominant amount of IULs are sold for that tax-free income in retirement, kind of the 401k alternative kind of concept, right? And so it's leaking into the becoming your own banker concept. But when you understand the tax-free retirement idea, so when you start taking income in retirement with these things, it's through the form of loans, which is a great thing. Like if it's a like whole life policy and you use it as a volatility buffer, or like as part of a greater plan, it could be a great thing. With leaning on the insurance company just to play the kind of like the major part of your retirement income is super dangerous with IUL, because of the fact that, let's say you start taking $100,000 a year of income, right? You're paying 5% interest on that every single year. Now, if you have years where the positive arbitrage is great, that's great. However, let's say you do it for 10 years, right? And now you're 75 and you need this money the most. You know what I mean? Mm-hmm. And now because you've been taking these loans all this time and the interest is compounding against it, right? Now, let's say you have $1 million in loans, right? Because they don't just go away, right? I mean, they're backed up by the death benefit the same way as whole life, but they don't just go away. Here's the problem. If you have a 5% interest rate, the market can do 1%, right? So even if the market doesn't lose, because you have a 5% interest rate, not on your $100,000 that you're taking for income that year, but on the entire $1 million that is outstanding for a loan balance. So what happens there is, if you have a 1% growth in the market and you have a 5% loan rate, even though the market didn't go down, this whole idea of you're protected against downside risk, you just incurred a $40,000 loss just to manage the loan expense. And the problem is then those compound because there's something called the net amount at risk. And that happens for whole life and IUL. It's much more egregious in IUL, like as far as the impacts that it has because of all the fees and the performance is all over the map. And so when you have those extra fees and they compound against you, you have 2 or 3 years like that in a row in an IUL and retirement when your cost of insurance is going up and all these things, the policy will lapse. And if it lapses, most of these companies have no lapse guarantees or they have overloan protection riders or something of that nature, right? But if they lapse before you're 75, which I've seen happen so many times, there is a massive taxable consequence and for most companies. And so you got to be really, really careful. I mean, I've seen people get whacked with tax bills on, millions of dollars of
because of growth.
Because when you get hit with the tax, you don't get just hit with the tax of the growth. You get hit with the tax of all the loan outstanding balance.
Oh, on the loan. Okay.
Yeah, it's nasty.
Yeah.
And so imagine you had a couple $1 million of cash value, but then you have a couple $1 million of loans that are in there. So now you got like $4 million. You get hit with the tax bill for the $4 million.
Mm-hmm.
And I don't
know. That's 4 words. Take a loan.
Yeah.
Can take a loan on an IUL, but then on the whole life side, can take a loan against cash value and will be charged interest. Well, we already heard from Chris that you're going to be charged interest on the IUL. And then he says on the whole life side, it will affect future performance. There is another lie. So just in this one piece, there's 2 lies. If you are taking a loan, and you guys all know this, I've done a whole podcast on how loans work with whole life. If you're going to take a loan against cash value, your cash value continues to earn the compound interest and dividends if you are with a non-direct recognition company.
Yep.
A direct recognition company, it's not going to be exactly the same, but it's still not going to be a catastrophic failure like the IUL sounded to be. And so it is just an outright lie because it does not matter. Your illustration is going to perform the same on the whole life side if you take a loan or if you don't take a loan. Here is what is going to affect the future performance on the whole life side is if you take a loan and you never pay the interest or the principal back. And you guys have all heard me talk about that as well. That I had a client that was a shitty banker and he didn't pay the principal or the interest and the policy blew up on him in about 10 years. And so you cannot be a bad banker. You have to be honest about it. This is not free money. And so is it worse on the whole life side? No, it's just that simple. I didn't have to explain all this crap that Chris just got done explaining. Because it's very simple. You take a loan, you earn what the company is going to charge you. There aren't these rates of return. Now, here's the thing that I am going to add about the IUL. It's the same as a variable universal. It's the same as universal. If they are putting a guaranteed insurance rider on there, why don't they just sell you whole life? If they're putting the rider on the policy, it means they know the policy is going to collapse at some point. And so now you have fine details to follow for that guaranteed insurance rider. It's on an IUL, a VUL, whatever. Just if you got the guaranteed insurance rider, just go buy whole life so that you know you have it. It just doesn't make absolutely any sense to even put that rider on.
Yeah. Yeah. I mean, all you have to do looking at an IUL is just look at the guaranteed column and have your agent run loans, look at the guaranteed column, see how it performs, and your head will explode and you'll run the other direction.
Same as VUL and UL
I mean,
and
it's
flexible premium paying and whatever.
Yeah.
Okay. The third thing they talk about is in an IUL, you do not have to pay illustrated premium, but should pay a mortality and expense risk charge. In whole life, apparently you have to pay the illustrated premium, or the only way around that apparently is to surrender paid up editions if available. So we have two more lies here. So I'm going to let you take the IUL, that you don't have to pay premium, but you should pay mortality and expense risk charges.
So this is all a conversation about flexibility, right? Like a lot of these agents like to talk about IUL being this like wildly flexible.
Whole life
product.
isn't flexible.
Yeah,
whole life is terrible. It's so stringent.
Right. I mean, you and I know that's not the case, and you can design at the end of the day. Here's the deal: you can design an IUL and a whole life to be very, very similar as far as flexibility goes, as far as all that stuff goes. The difference is when you sign on the dotted line. So I like to use this analogy, like, and this is really relevant to this point specifically, is if you had a contract and you were looking to get into business with somebody, right? And you had two contracts in front of you. Like, let's just keep it really, really simple. And like, look at two contracts. And you said, all right, one contract I can sign on the dotted line and all the numbers look relatively similar. Maybe one contract, the numbers look a little better. I have the potential to maybe have a little more equity in the business. I have the potential to cash out and exit and make a little more money on the back end or whatever. I have that potential. However, as soon as I sign on that dotted line, my business partner controls everything. Has all the legal rights and abilities to change everything on that sheet of paper, to change all my exit strategies, all my income, all my revenue, all my retirement, everything that I'm planning in this business. As soon as I sign on that dotted line, none of it matters because it's all in control of my business partner. And then the other one is a contract that says, I'm going to sign on the dotted line. And as soon as I do, my business partner in that business has all the obligations to meet the contractual demands that are in my control, right? I just defined to you guys IUL and whole life. I don't know a person in the world, when looking at this objectively, going into a business relationship, would sign that contract unless you're absolutely desperate, like nobody. Everybody would take the one where when you sign it, all the obligations are on them to perform according to your requirements, your needs.
I love that analogy. That is such a good analogy. That is so perfect because it's exactly true. And I talk about this all the time, that in a universal product, there are costs of insurance and there are charges that they have a max amount they can charge. And we can go back and look at why companies have been sued in the past. And they've been sued because they're increasing the cost of insurance to cover their butts when they overprojected a rate of return. And that is not performing as should. And so it's funny that they say, so you don't have to pay the illustrated premium, but you should at least pay the mortality and expense charges. So what happens when we are 75, Chris, and all of a sudden our mortality and expense charges are more than our illustrated premium? So now you're saying whole life doesn't have the flexibility, but in an IUL, you either pay this or the policy lapses and it's gone. So there is a certain amount that has to be paid. I have seen illustrations. I actually saw one early on in my years. So this was probably 10 years ago. That it was a universal, it was a variable, it was a VUL product. It was not IUL. It was a VUL. On the left side of the illustration, it said, to keep this policy in force until age 100, the premium must be, and it showed the premium. That premium was exactly what my whole life premium was when I ran it for them.
Oh, that's
funny. To keep their policy. So don't tell me you're not getting a better cost, which leads us into the next conversation, but you're not getting a better cost in one versus the other. If you underpay that premium in an IUL, it's gonna underperform, correct?
Yeah, of course. I mean, there's target premium, there's minimum premium, and then there's, whatever the guideline premium that you're able to pay in an IUL, all three things. Unfortunately, it's sold on target premium because that's how the commissions are calculated. And that's all these agents seem to care about, I think. And so they focus on that. Well, the disgusting thing is I've seen policies that are sold on target premium but are funded at minimum premium, right? So the people are paying, but the agent's getting paid. The people are paying a minimum. Let's say 5,000 is the minimum, and the target premium is 8,000. Well, the agent's getting paid on the 8,000, and the person is paying, and they just do this because they're just trying to get the policies in place, because they get paid that way, and they sell this flexibility. They say like IUL is more flexible than whole life, because all you have to do is pay what's that say, illustrated premium, but should pay a mortality. They should pay, should pay. I mean, guys, it's life insurance. If you think you're getting through this without paying that side of it, like, once again, I got a bridge to sell you. Like, come on, like, understand how this stuff works. Like, use common sense, and it'll take you a long ways. And
and on the whole life side, you have to pay the illustrated premium or surrender paid up additions. So yes, there is a minimum. With all of my clients, we go over your minimum and your maximum. And ideally, you want to fill it to your max. Now, I have some clients that are doing nothing but paying minimum for whatever reason, right? We've had to start calling clients and be like, hey, you forgot to add extra money. Because what happens is the insurance company bills them a minimum amount based on how they paid the first time. So the insurance company and they forget and they don't call and talk to you. So we're babysitting, which is fine. That's our job.
But that's why you need to work with somebody like MJ or us, like that knows what they're doing. Right?
Yes, so that you are constantly paying what you need to pay. Now, you have to pay the illustrated premium. Yes, your minimum is going to be your illustrated or your maximum. There's flexibility in there. But you do not need to surrender paid up additions to pay your premium. That is such a huge lie. I have never, ever, 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 ever had somebody surrender PUA to pay their premium. No, you can borrow money from cash value to pay premium. I've done that on my policies. You can switch it to monthly. You can go to the minimum, whatever. But either way, you are going to have to pay a premium, and there is just as much flexibility. Here's the funny part of this document. He says, surrender PUAs if available. So the fact that he knows about PUAs and the fact that he understands that means that he understands whole life with paid up additions rider, which is what Nelson taught us to do. The PUA rider, all you have to pay is $120 a year. Most companies, that's all they're requiring is $120 a year to keep that rider active. Some companies have a 3-year rolling average. Every company is a little bit different, but your agent better be explaining that to you so that PUA rider doesn't fall off. Now, my clients that are paying just the minimum, guess what? They're still building cash value. Basically, if in a whole life policy, all you ever did was pay the base portion of that policy that buys whole life, if that's all you ever did, you have an old-fashioned whole life policy that is going to be a beautiful policy in 20 to 25 years. If all you ever did was pay the minimum on the IUL side, but you should pay mortality and expenses. And he put that in there because if you don't, the dang thing is going to collapse on you. And every year those mortality and expenses go up. With whole life, guess what? The base portion of that policy stays the same until the day you die or you outlive it at 122. So lies, 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 lies. So we're on to 6 lies.
It's obviously this document is obviously being intentionally deceptive, right?
Oh, 100%.
It's not. I mean, it's pretty obvious at this point.
I mean, if this guy, this is the fact that everything on here is a lie, and it's not even misleading. It is a downright lie.
Yeah,
this to me is grounds for losing a life insurance license.
Do you know who the agent is, out of curiosity?
I know the first name of the individual. I do not know who it is. If I asked, I'm sure I could find out. But okay. The fourth one, cash value is guaranteed in an IUL, and there is less mortality and expense risk charge.
Oh my God, did they really write
and
that?
In a whole life, cash value is guaranteed after dividends are credited. Oh, I can't even express how angry this makes me. Okay, in an IUL, cash value is guaranteed and there is less mortality. It's all yours. Tell me your thoughts on that.
So you want to hear a funny story? So am I allowed to name names of agents and people that I'm spatting with? Or do you want me to keep that to myself?
If you would like, that's fine. That's your call. I don't usually get into other agents because I don't ever talk about other agents. But yes, I know you are spouting.
I'm battling.
They can go to your channel too and see because you're wide open.
I'm spatting with some people who are pretty well known in the IUL space, and I'm calling them out because I just think that's my job. And so there's a guy named David McKnight. He wrote a book called The Power of Zero. He's a big, huge, probably one of the top IUL advocates in the country, and he did a video debunking me on it. I didn't go after him, but you go at me like if you swing, you better knock me out because I'm coming back and I'm gonna swing harder. And so then he did like a 12-minute, 14-minute video, something like that on me, and then I said, all right, and I had, by the grace of God, had a guy reach out to me 3 days later after his video got launched with an illustration asking for a review of an illustration of David's favorite company. And so I was like, oh my gosh, this is like so perfect. It was like silver platter delivered. It was amazing. And so I'm like, I took this policy and I did a full review on it. And then I debunked David's debunking. And so the reason I bring all that up is to talk about this. There was a guy who was paying, and you can go see the video, $16,490 a year for 10 years. And it was a younger person because everybody says IULs are really good for young people, right? Like if you're young, maybe not for old people, that's what some of them say. Like, but if you're young, and this kid was like 17 or 18 years old, and he's like funding $16,490 a year for 10 years. And then it showed on the illustration, it showed not paying any more premiums after year 10. The thing with IUL, and I don't think it gets into all this, but the thing with IUL compared to whole life, they say it's flexible, but you can never pay it up. Like with whole life, if you get into a spot, you can do like an RPU or reduced paid up option. If it's funded properly enough, you can use a premium offset feature. There are things you can do with an IUL. If you can never pay it up, it's annual renewable term. And so what happened was we looked at this and I said, all right, you can't. And this is one of my favorite things to understand when you think about this with IUL. It's like everybody says it's cheaper. Well, yeah, it's cheaper and it's got less mortality costs for the first 10 years if you're young, right? Because they're using annual renewable term, and that expense, that insurance cost, is going to get more and more expensive as time goes on. The reason a whole life is more expensive is because they level that out over all the years of the policy, right? So yeah, it's more expensive, right? I went through this illustration, and if you go into any IUL illustration, always ask for the expense report, and then there's going to be a cost of insurance department or like column, right? So I went through this cost of insurance column and I looked at it. And by the time so remember, what did they pay for this policy? They paid $164,000, $16,490, like $164,900 over a 10-year period. By the time they were 80, I think 82, you can check the video out for details, but like by the time they were 82, the total expenses of this policy, insurance cost, was $964,000.
And who paid that to even keep it going that long?
It came out of the cash value, but all that assumption was based on the policy growing, all the things we were talking about earlier.
Right. What rate of return?
Yeah, it's 6.25, but positive
every single year.
Which is never going to happen. And
right.
It's assuming positive arbitrage on loans every single year, even though 35% of the time they're going to be negative, right? Mm-hmm. Like, so there's all these assumptions that go into
an average, because they're figuring average rate of return versus actual rate of return. And if you guys listening don't understand that, that is a whole page in my book. It's average rates of return versus average versus actual. It is not the same thing.
And it's way worse when you talk about doing it inside of IUL, because here's the deal. When let's say you have $1 million of death benefit. I'm going to get really nerdy here for a second. So let's say you have $1 million of death benefit and you have $500,000 of cash value in the policy. That's a $500,000 net amount at risk, right? So your cost for the annual renewable term is the spread. So it's $500,000. So as you and I know, when you get older, the cost of annual single year term insurance when you're 75 and then 76, the costs compound in a nasty, nasty way, right? Because the risk to the insurance company is significant, right? Like the older you get. Here's the problem. If you're 75 and that $500,000 of annual renewable term, and then you have loans out on it going up to that point in time, right? Like that $500,000 of ART is the net amount at risk. Then that year the market goes negative. And let's say you have a couple $1 million of loans and a 5% loan rate and the market goes negative. That's an extra $100,000 of interest. What does that do? Well, in the next year, if you want to pull income, let's say you're pulling $100,000 a year of income. Now you have the $100,000 of interest expense and the $100,000 of income, and it's coming off that $500,000 that you show there. So the problem is now what happens is you now no longer have 500,000, you have 300,000 of cash value. So what does that do? That increases your net amount at risk by $200,000 because now you got 700 grand instead of 500 grand. That's a 40% increase in your cost of insurance charge, which at 75 to 76 is a huge deal. And so like it takes one bad year like that and your whole financial plan goes out the window if you lean on IUL being your main vehicle for retirement income.
Yeah. So less mortality risk wins. So here's also the logic that I think, and I'm glad that you explained it that way. I make it a little more simple in my brain. And it's, okay, if I go to the insurance company and I say, I want an IUL and I want a whole life, I am the same person there insuring on each one of those policies. I'm not healthier on one than the other. It is the exact same health rating. I'm not going to die sooner on one than the other. The only thing that might happen is they might know on the IUL that thing's going to lapse before I die, so they don't have to take as much risk.
Yeah.
And so the charges might be less than the whole life because I'm going to die on their watch with whole life. The other thing is I can sell you a little bit cheaper insurance on the IUL because the market's going to make up the difference. Where in a whole life, it's all guaranteed. There's nothing there. So when he says cash value is guaranteed after dividends are credited is more BS because cash value is guaranteed. There is a guaranteed column. When dividends are paid, they then become assumed and they go to the guaranteed side of the policy and they can never take them back. So on the non-guaranteed side, that is assuming we're going to pay a future dividend. But the guaranteed side is, hey, interest is paid. This policy has to equal cash death benefit and cash value must equal each other at age 121. That is called endow. So the policy must endow at that age. Now, the dividend is going to be assumed. So the fact that he's saying it's not guaranteed or it's only guaranteed after the dividend is credited is BS. What he should be saying is the cash value is always going to grow, but once the dividend is paid, it is credited and it even grows the guaranteed side faster than what is illustrated. So the illustrated amount, this is what Nelson always said. The illustration is nothing but lies, lies, and lies. He always said that. And he said that because the second that illustration is printed does not mean anything because dividends are going to be higher or lower than what was illustrated. It goes over to the guaranteed side. It becomes assumed. And now everything is far better than it was. So those of you with whole life policies, if you are running in-force illustrations, you will see your guaranteed side is actually far better than what it was supposed to be because the dividend has been moved over. So many people get hung up on the non-guaranteed side saying, well, that's off. Okay, but all these dividends went over on the guaranteed side. So again, we have this misconception that our cost of insurance with an indexed or a UL product is less. It's not less. I'm the same dang person. I am not healthier on one than the other. It's just how the policy is structured to make it look that way. And the risk is put on you, which is exactly what you said earlier with the contract stuff. In an IUL, you are carrying the risk, not the company. In a whole life, the company is carrying the risk, not you, the insured. Same as a 401k and IRA, you are carrying the risk, not the 401k company, not the IRA company.
Yeah.
Your financial advisors they have no risk. That's why they don't have to do their job.
They're getting paid.
Okay.
Though.
And they do, yes. Okay. And then on the mutual, and he doesn't, this is interesting, how he doesn't have anything on the IUL side of this bullet point, but on the whole life side, he has, you have to take loans after withdrawing cost basis.
That's ridiculous.
And so you don't have to take loans after withdrawing on the cost basis. And so for those of you that don't know, the cost basis is what you have paid in. The total of what you have paid in is called the basis. And so if you've put $500,000 of premium in the policy and you have $800,000 of cash value, you can borrow or you can withdraw 500 and then you have to borrow the 300 is what he is saying. You don't have to borrow it, but you want to because you don't want to have to pay taxes on that. But my question is, like, that's obvious on the whole life side of things.
Mm-hmm.
But why does he not have a bullet point on the IUL side, Chris?
Like I said, I mean, this isn't just it's an intentionally deceptive document that's designed to get you to like go a direction, like the principle of that.
You don't have to withdraw. You don't have to withdraw
cost
basis.
You don't have to withdraw to cost basis on either one. Can you?
No, you don't.
Can you? Should you? I don't know. It just depends on the situation. Every scenario is a little different, right? I would say
it depends on where you are at retirement. So I have clients that are in retirement age. They have sold the business. They're not farming anymore. There is no cash flow coming in. And so in that case, we will withdraw cost basis and we will borrow the growth to make the money last longer. But that is only a strategy if you're not paying premium. If you're going to continue to pay premium, you're probably going to want to borrow. If you can pay interest only, you're probably going to want to borrow. So everybody wants this cookie cutter approach of what we need to do at retirement. There is no cookie cutter approach.
Yeah, I got news for you. If you think there's going to be there's so many variables in what that would look like and what approach you're going to want to take in retirement. If you got 20 years until retirement or 15 or 10, nobody knows what the world's going to look like. I mean, I got news for you. Nobody knows what the world's going to look like in 2 years right now, right? It's, so to think that you're going to have all that figured out is delusional, in my opinion. And that's one of the reasons I'm such an advocate for utilizing whole life insurance, is because these life insurance companies weather storms better than any other financial institution. Having that money, having control of that money, having the flexibility of that money, being able to have it as an opportunity fund or as a guaranteed emergency fund or for whatever you need in retirement it's going to be one of the most powerful financial tools on the face of the earth. And people are, I think, going to only wake up to it on a mass level when it's too late. And so that's why I do what I do. That's probably why you do what you do a lot, is just awakening people to this ahead of time. But, when it comes to that whole withdrawal to tax cost basis, and it works the same with IUL and whole life. The principle is the principle. I would argue IUL, because of all the things we've talked about, is infinitely more risky and dangerous. But should you be fortunate enough to get to retirement and even have money in your IUL, I would say don't just start taking loans. Do a withdrawal to cost basis potentially, because it's the same concept. You're not going to have the loan start compounding against you. That would mitigate some of the downside risk and whatever on bad years after a period of time. But remember, the way these grow, depending on how long you've funded it, you can only withdraw up to what you've contributed to avoid taxes. And then at that point in time, that's the whole withdraw to cost basis. And then you're going to have to borrow against it after that. It's a really sound strategy. That's why I like whole life as being a really key kind of piece of the puzzle as part of a bigger plan. So
and then I just want to add that the dude that did this document or got this document, shared the document, he is an estate planner. And so he is not an attorney, but he is an estate planner. And ironically, nothing in this document actually talks about the risk of not having the death benefit there as part of the estate plan. And that is a big factor for most people listening to my podcast, is if the whole plan was so that the off the farm kid or the kid that's not taking over the business is getting the death benefit, there's not going to be a death benefit in an IUL, most likely. and we'll talk about this in a minute, but Chris actually has a challenge out there that he will pay people to send him IUL illustrations if they're good. And so we're going to promote that challenge. Yeah. But nice. we have, if you are doing this for estate planning and you have an estate attorney that is not promoting whole life, what I've seen this many, many times where I am meeting with a family and the policy that is supposed to go to the off the farm kids isn't there. If you don't think that that's going to start World War III or cost you the farm or cost you the family business, you better open your eyes, because this is going to be World War III. There is going to be family that does not get along. And this is the stuff that an estate planner is promoting. And so this to me is just downright criminal. And none of that was even addressed. But the fact that there's no bullet point on that last point, is it because we know that IUL is not going to be in the picture? Even in whole life, I am adding term riders to whole life. Mm-hmm. If you are young enough, I will make sure that rider drops off at 65. I do not want it on there because it will affect cash value, because there's a cost over 65 years old. And so if you're 65 coming to me, we can't always, it's still a good policy and I will still maybe add some depending on the situation. But there is a cost. And so the renewable term is going to be a cost. All right. Tell them your challenge.
Okay. Yeah. So this challenge was just inspired because I got tired of hearing all these IUL agents telling me they were right and I was wrong. And I knew I was right. And I knew they were wrong. And so I was like, all right, smart Alec, put up or shut up, basically. And so I created the IUL challenge and said, basically, all right, here's the deal. You say that IUL is sold with upside potential and downside protection. And we just came through the greatest bull run in the history of the market. So therefore, every IUL sold in the past decade up until like a year ago should have outperformed the illustration because, I mean, we had the greatest bull run of all time, upside potential. You're right. Take advantage of that. So the idea was, I don't even need you to show me the illustration showing an in-force illustration, showing that the policy beat it by the percentage the market outperformed normal like performance. I just want you to show me that it matched what you said it would do in this great bull run. And so I started off being like, anybody that can do it, I'll give you $500. If you could show me a policy that's 10 years old, show me the original illustration submitted with the policy, and show me a policy now that's in force, just matching what it said it would do when you sold it, I'll give you $500. Nobody did it. And so I said, all right, maybe I didn't pay him enough. I'll give him $1,000. So I said, I'll give him $1,000. And so, bang, like I offered it, same thing. I had a couple people be like, I could do it. And I got on the phone with them and I could tell they were kind of just trying to trap me and like whatever. And I had no problem. I got on with them and like whatever, we battled a little bit. And then they ghosted me. Like they just disappeared, right? They didn't they had a lot of talk. There's a lot of people that like to talk in chat groups and say they could do it. And then they ghost me all the time, 100% of the time. And so $1,000 wasn't it. And so now I'm offering $2,000 to anybody that could just show me an example. I just want one example, guys. Just like there's been 1 million policies sold, right? There's got to be one of you out there that can do this.
Chris is like the airline companies. Okay, 500's not enough. We'll give you 1,000. Now it's $2,000. All you have to do is get an in-force illustration, show them that it matched what they illustrated. $2,000 free. Just shoot them an email.
Say, if you're a consumer, if you're somebody who's looking to buy a policy, here's what I would do. Like imagine, Mary Jo would never do this to you, but imagine Mary Jo is trying to sell you an IUL right now. I would say, hey, Mary Jo, how long have you been doing this? And if she said less than 10 years, I would say, all right, first of all, you haven't been around long enough to even see how these things perform long-term. It's a risk. Let me go the route, whatever. But if she said she was in it for 10 years, I would say, all right, can you show me an example? You can, hide the person's personal information. Show me an example of just maybe 2 or 3 of these things working. I want to see how they worked at different funding levels.
Well, they should be the agent's own policy, Chris.
Yeah, I mean,
the agent should have a 10-year-old IUL policy. Yeah. These agents should be able to show you what the policy has done.
That's true.
I mean, it's not like you have to pull up a client's illustration.
Totally. And so, but at the end of the day, I want to see a couple of them, because here's what I will say. I know it is possible for an IUL after 10 years to perform if it was designed perfectly, if, all the variables, if it was with the right company, there are certain ways, and I've done it out, but the problem is 1 out of 1,000 agents will actually do it that way. So I'm literally looking for that 1 in 1,000 person to come to me and show it to me.
Well, it's the same as ULs. I mean, in 13 years of me teaching this concept, I have now seen 3 decent ULs.
Yeah.
And they're not variables. They're not IULs. They're universal life, which is a different animal a little bit from the other two. Because those early years, they were guaranteed. They were a guaranteed type product. And so if the company hasn't raised the cost of insurance, they're still there and they're good policies. And they're going to remain good policies if it's a good company. That doesn't need to do that. And so I've seen 3 of them, but in 13 years, that's not, and I see probably 3 a week. So it's not like I don't hardly ever see illustrations.
Right.
Okay. I have a meeting, so now we have to quit talking.
Go.
But I thank you very much for being here.
Thanks for having me.
Appreciate the time. All right, guys, you know the drill. If you have not gotten the book, go to withoutthebank.com, farmingwithoutthebank.com, grab the book, read it, schedule your appointment. Happy to meet with you. If you have questions, email me, maryjo@withoutthebank.com. Have a fantastic rest of your day.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.